Well, greetings and welcome to our video for our Outlook 2025, what we're calling gravitational shifts. Now, 2025 marks the midpoint, really, between for the decade, so between 2020 and 2030. Remember, 2020, we started with that pandemic. But it's also the midway point, halfway between 2000 and 2050. And we're going to talk a little bit about some longer-term thinking. But why gravitational shifts? Well, we think of it as a pendulum, right? There's an analogy to a pendulum where things tend to sometimes swing to an extreme, and then gravitation kind of takes over and it starts to swing back. And so we think on a number of fronts, we've hit those extremes and we're moving back. Obviously, we'll get into the election and the political environment as one example. This idea of a lot of regulation, maybe moving to deregulation. And then the markets, for example, being really focused in terms of performance on things like the Magnificent Seven. So it's sort of a smaller number of larger, especially tech-oriented companies, and what we're expecting is a broadening of the market. So that's what came to mind, this idea of a pendulum, and therefore the idea Outlook 2025 gravitational shifts. Now, what I'm going to do in this video is basically run through the reports relatively briefly. We'll spend a little more time, of course, on our outlook, but the report itself is made up of a number of articles. There's a review of last year, 2024, and then the Outlook article itself, right? So we'll get into what we think for 2025. Allocation insights, we'll talk about how we're thinking about the markets and where we're neutral versus some leanings. Our colleague, Chief Washington Policy Strategist Brian Gardner, penned an article called The Washington Policy and Political Outlook. And then we've got our geopolitical risk dashboard update. And then, as we often do, an article related to that, in this case around U.S. and China. We think of it as 4 ways forward. So almost like pushing ourselves to think in 4 different scenarios as it relates to the competition between U.S. and China. And then we'll finish up in terms of articles with a fun one, really, the world in 2035. So almost like brainstorming on 10 different transformative ideas that we expect to see in 2035. And I'll close out with a few other topics that we'll cover in the report itself. So anyway, let's jump in and look at a 2024 year in review. I think we all agree that 2024 is a surprise to the upside. So we expect the economy in the U.S. to have grown 2.7%, well above long-term trend, well above the consensus expectation as we started the year. The consumer was resilient. The labor market remained strong. Inflation started to ease, thankfully. We saw a few struggles in the housing market, really related to high mortgage rates and somewhat limited supply. But overall, things like inflation did trend back down towards the Fed's 2% target. As we know, that gave the Fed some room to begin their rate cuts. And so we'll get into our forecast for this year, but they made a few cuts and basically are signaling that they feel that they've had inflation reasonably under control, but there's still some uncertainty there. Now, in terms of the market dynamics, I mentioned this concentration, this focused market, that Magnificent Seven group: Google, Amazon, Apple, Meta, Microsoft, NVIDIA, Tesla. These companies together performed very strong in 2024, 67% for the Magnificent Seven index for last year. So that's a huge number, obviously. And that really contributed to the cap-weighted oriented indices. So the S&P 500 itself, a cap-weighted index, up about 25%. The broader Bloomberg 1000, another sort of core large cap index, up over 24%. And then what we see is in other parts of the market and other styles. So, for example, the S&P equal weighted was up 13%. So that focused concentration of the Mag 7, for example, had an influence. Or companies were smaller, like the Bloomberg 2000, up just under 12%. Outside the U.S., EFA, that's the Developed Market Index, up 3.8%. And that includes, for example, Japan being up over 8%. Emerging markets up 7.5%. China up at 19.4%. So a lot of variety around the world. People tend to focus in on the best performer, right? These big market cap-oriented indices in the large cap space in the U.S. really anchored on those Mag 7, did pretty well. But anyway, long story short, to round it out with bonds, we basically saw the bond market as measured by the Bloomberg aggregate just up over 1%, which means rates rose a little bit through the year. And then the muni market up about a little over 1% as well on average. So anyway, think of it as a varied market, generally positive. And so, of course, that's going to inform how we think about things going forward. Finally, to round out the year in review, of course, we had the elections, led to a Republican sweep, really, so a unified government as we enter the year. And that really did bolster some optimism around business-friendly policies. So anyway, with that, let's jump into our outlook for the year. So I mentioned the pendulum and this idea that when it comes to politics and the related policies, when it comes to the economy, perhaps, and then the markets, we expect to see some shifts. So obviously, the shift in leadership in D.C. is significant. And I would expect the economy, anyway, we'll get into some specific estimates, to continue to be positive, but perhaps slow a little bit, relatively speaking. And then as it relates to the market itself, we're expecting the markets to broaden out. So think of it as returns across different sectors, beyond mega cap tech, as well as different parts of the world, honestly, to other areas to sort of demonstrate some positive returns. And that's sort of against a backdrop, at least in the U.S., of some stability, if you will, in monetary policy with the Fed. They've been signaling, kind of moving slowly. So that's sort of in line with the market expectations. It's in line with our forecast. And so that helps in terms of just understanding where rates are going. Now, as I mentioned, with shifts in D.C., we think the pro-business reforms, so things like deregulation and infrastructure spending, could drive optimism. But we do have some challenges I'll get to in a second. Another area that we're very optimistic about, we continue to be optimistic about, is innovation, really technology, particularly artificial intelligence, things that will just continue to contribute to company performance, economic growth, and therefore opportunities as investors. Now, I mentioned challenges. I've talked for many, many months or years almost about the fiscal trajectory in the U.S. So the idea of us having elevated deficits, building debt, that's an issue that needs to come into focus. We think it will come into focus with the new administration. And then, of course, we've got the ongoing geopolitical risks, hotspots around the world, which we'll get into in just a minute. So with that, let's talk about our forecast. We're forecasting for U.S. GDP, a GDP to fall somewhere between 1.5% and 2.5%. So in round numbers, right around longer-term trend, which is 2.1%. And then core inflation we expect to fall, but not all the way back to the Fed's 2% target. We expect from the Fed 1 to 2 cuts this year. So I think everyone's come to the understanding that they're going to slow down, really to make sure inflation doesn't reemerge strongly and so forth. In any event, as it relates to a market forecast for the S&P 500, which is kind of the traditional thing to forecast, we have a year-end estimate, very round number, of 6,200, which would translate to a return of 6.7%. When it comes to the 10-year Treasury rate, we see rates hovering in the range of where they've been, think 4.25 to 4.75. And then when it comes to the spreads on corporate, so investment grade and high yield, maybe just a little bit higher than what we've seen in the current market environment. So overall, I would say a generally positive view as we look forward. Now, as we do this, and I mentioned that round number for forecast, one thing we know is when you're making a point forecast, the chances of being right are pretty low, right? You're kind of trying to generally get a sense for the direction of the market. And so one of the things we do every year is we really force ourselves to evaluate and analyze 3 different scenarios. I've just talked about our base case, which we're assigning a 60% probability to. And it's pretty positive, right? But then you can say, hey, it could get better. So our bull case, which we assign a 15% probability to, is that idea of innovation and, let's say, efficiency from the government accelerates growth, and the Fed maybe is able to even cut rates faster that will sort of help the consumer and businesses. All that could translate to a stock market that's even better, thinking in the area of 15% for returns. Then our bear case scenario, which could anchor, for example, on the idea of inflation reemerging, forcing the Fed to maintain higher rates, maybe even take rates higher. And we are assigning the remaining probability, so 25% to this, or things like geopolitical tensions and the fiscal strains that we've talked about, that first fiscal trajectory sort of dampening growth. All that could lead to some nervousness in the market, could lead to a correction in the market for sure, and could sort of constrain limited upside on the equity market, therefore making it a little bit more limited. And so again, as we think about our outlook, overall positive, but making ourselves think through the tails, the bull and the bear case scenarios. Now, related to all this, of course, is we do like to comment on asset allocation, what we call allocation insights. So it's another article in the report. And basically, what it comes down to is we expect, as I mentioned, that there to be broadening market leadership. So when we look, for example, at all the different sectors in the S&P 500, one index where we could get pretty reliable data on the forecast for earnings growth, basically the earnings growth forecasts are getting better outside tech and those big tech-oriented companies, right? So the idea is that investors are expecting other companies to perform better. It's going to be, again, against this backdrop of some shifts in DC, and that should allow for underperforming companies to start to rebound, right? A broadening of the market. We did see that, by the way, start a little bit in July of last year. So again, think of that as the view of it is to continue. And then as it relates to fixed income, our view is that bond yields will remain attractive. I gave you our rate range. And so, really fixed income serves as an anchor, right? It's providing cash flow, but also if you have duration in your portfolio, which we're recommending, that's sort of a place to be if and when the equity markets turn volatile and turn negative. Bonds tend to perform on average better in those kinds of environments. So one thing, just a minor point, if folks have their fixed income oriented towards the shorter end of the curve, which has been very popular because rates have been high, we think it's a good time to extend back towards a market duration because that is the thing that helps if we get into a negative equity market. Rates tend to fall a little bit. Durations mean that positive returns can be earned in that type of environment. So duration is the thing really that provides that diversification. Now, another thing we did get into this time around when it comes to allocation insights is increasing product innovation in the area of alternative investments, what's known in the industry as the democratization of alternatives. What that means is, hey, you can get access to private equity, real estate, some hedge funds, structured products in vehicles really intended for smaller investors, smaller amounts. And so it's just a good opportunity. These products are really viewed, and capabilities really are viewed in some ways to enhance returns. So private equity, the whole idea of doing that is to get a better return than public equity, and that's the goal, that's the work. But then when it comes to hedge funds and structured products, that's more of a risk management tool. You're diversifying with tools that intentionally have typically some downside risk protection. So again, it's a good topic to consider and talk to your financial advisor about. In any event, when it comes to our thinking, I just always take the opportunity to reiterate that our investment philosophy is about being diversified. We anchor everything in what we call our strategic asset allocation. So allocations to different asset classes. In a number of places, we remain neutral, stick to our strategic asset allocation. We do have a few overweights, which we've had for a while, actually. One is to be overweight quality. We think it's a good environment to do that. We happen to be overweight in the large versus small cap space to small cap for actively managed strategies, especially given these changes going on in DC, and then for reasons related to our confidence in the country, its policies, its economy a little bit, we're overweight Japan versus Europe outside the U.S. And so with that, let's turn to a next update, which is from our colleague Brian Gardner, again, Stifel's chief Washington policy strategist. And he basically penned an article called The Washington Policy and Political Outlook. It's just a great colleague to have. He'll be with me, by the way, on our upcoming webinar for our Outlook. In any event, Brian basically gets into, of course, the incoming administration's ambitious policy agenda. And while on one hand, he's sort of optimistic about different layers about it, he does observe, of course, that there will be challenges. So we'll see some work done, basically negotiations on things like tax policy. We'll see tariffs go up and the implications of that. We'll hopefully see some at least modest changes in the budget. We'll see deregulation and maybe some shifts in antitrust enforcement. And so, I'll really leave it to you to check out the article or check out our webinar. But Brian is, I would say, modestly optimistic, but recognizes that in DC, everything gets done through negotiation. There's a lot of work to do for some of these changes to be implemented. Now, more broadly, our geopolitical risk dashboard is something we update periodically, but especially with every Outlook report. So we continue to talk about our U.S.-China competition risk, if you will, that's in there. And we see things happening where, there's just changes going on, where people are changing supply chains and changing trade policies. It does create opportunities for other regions. Think India, think Mexico. And I'll talk about U.S. and China in a little more detail in just a second. But we also this year sort of broke out and highlighted what we think of as the military conflicts, either existing or potential. So you can think, of course, Middle East. You can think Russia, Ukraine, the tensions between Russia and NATO. You can think Taiwan as a possibility. You can think South China Sea more generally. And so, again, the whole idea with this report is to identify and frame out the different risks we see going on around the world. Within the U.S., we talk again about that fiscal trajectory as an important geopolitical risk, and even things like climate policy and how that gets implemented, where folks are still trying to implement these things. That does create, for example, inflationary risk. And then finally, the overarching trends. So we've talked a lot about this shift that seems to continue to be going on from globalization to localization. And then the idea of this footprint of global trade being reshaped. It's going to be influenced, for example, with the tariffs. That's another example. So anyway, a nice update to our geopolitical risk dashboard. I mentioned earlier this article, Crossroads, 4 Ways Forward, and this relates to the U.S. and China. So think of it as what we did is we basically modeled out 4 scenarios, and I'm going to walk through them. It's essentially, is the U.S. leading? Is the China leading? Are we both moving ahead together? Are we both moving behind together? So the first scenario I'll mention is the U.S. dominating. So the idea of us being re-energized as a global leader, and this could be related to us getting stronger when it comes to our policy, getting stronger when it comes to fiscal trajectory and kind of managing our debt and reducing our debt eventually. Of course, it would relate to our continued dominance in technology. And, if you sort of think of that as happening, but China may be struggling with an aging population or a weakening local economy, maybe losing trust around the world, you can see China potentially falling back, and that could result in folks trading away from China a little bit, both here in the U.S., of course, but elsewhere as well. So that would be the scenario of the U.S. dominating. Productive competition would be both of us moving forward positively, right? So the idea is that we're both avoiding conflict. Maybe we're actually collaborating on certain things, sort of sharing technology, figuring out ways to work together, and both countries sort of thrive and move forward. And that, that idea of sort of accepting one another and finding ways, at least in the context of the way we see things, to work together is the idea of productive competition. Now, the fragmented world would say, gee, China and the U.S. are actually going to lose ground to other places, right? So we both face some economic and or political challenges. Maybe our influence around the world for each starts to wane. We see the world become much more multipolar, and trade fractures, both for us and China, could unfold, right? So again, it's all about how countries are fighting to compete and where the technology gets built and the innovation happens. So that's one scenario that the article frames out. And then finally, the last one is China taking the lead. So maybe here in the U.S. we see political polarization, we see a fiscal strain, maybe inflation kicks up and the economy rolls over, so we have stagflation. But problems, right? Think of it as problems that we're wrestling with at the same time. China kind of continues to fight and maybe has further development in terms of technology and sort of demonstrates leadership, and they've got their negotiations and work going on all around the world. So that fourth scenario is China taking the lead. In any event, it's just one article where we almost same thing as scenarios, right? Just trying to force our way to think through different possible scenarios and what the implications of the current environment might mean. In any event, in terms of articles, let me close out on one that we entitled "The World in 2035, 10 transformative ideas. And so again, we do have this work that we do, our long-term investment themes. And, so we're always looking at companies and how they're developing as we do our investment work. That's an anchor to how we're thinking about things. As we're looking at longer term trends in the economy, that these are anchors in our thinking. So it was fun to kind of think creatively about what are 10 different things that might happen in a decade. So the first, and I'm going to just run through them really quickly. The first is quantum computing, right? So think of it as just this massive improvement in the speed of computing. We think drug discovery, material science, financial modeling, all kinds of things that could happen. The estimates are a $2 trillion economic impact. Next up, rise in bionics. So think of it as advanced prosthetics, brain chips, artificial organs, all for quality of life, and even the potential to restore senses and mobility for people who've lost those, right? Next up would be vertical farming. So the idea of AI-driven indoor farming done vertically to offer food and reducing the dependence on land, water, and even pesticides. So it could revolutionize agriculture. Now, we've had a lot of debate within the firm about nuclear, but one idea is the potential for small modular reactors. So basically, cleaner, more scalable alternatives to traditional nuclear power plants, but basically used to address the rising energy demands, especially as it relates to AI and the digital infrastructure that we have up there. Now, next up, a couple in healthcare. The first would be AI in medicine. So this is the idea that the use of artificial intelligence continues to be applied to things like drug discovery or simulating clinical trials, really with the idea of revolutionizing how we might understand disease and treat disease, and ultimately focus as well on longevity, how to help people live healthy and live longer. A second healthcare item would be digital twins. This is the idea of almost like having an individual modeled in a more digital sense, keeping track of, it could be sort of your own DNA, your own conditions, all that kind of thing, and being able to sort of understand what's happening and ultimately personalize medicine, maybe look for early disease detection, and ultimately optimize wellness. Now, next up, I would say is AI agents. So these are things that we're actually familiar with right now, right? So you call an 800 number and you get an AI chatbot helping you out. But just think of that as going a lot farther. So think in terms of, gosh, it could be the law, it could be education, it could be healthcare, all kinds of things where the AI sort of representatives get smarter and smarter. Next up would be, this is kind of fun, flying taxis. So the idea that ultimately we're going to marry this idea of almost like, it could be driverless too, right? Sort of drones and sort of driverless vehicles, but in the air, ultimately being able to take people around through that form of travel. Next up, humanoid robots in warfare. So the idea that robots could actually be out on battlefields and handle dangerous situations. Obviously, that would be a benefit in terms of reducing casualties, et cetera. Or think of things like reconnaissance. And then finally, end up with the space economy. Again, something that's we see happening, but ultimately, gosh, think in terms of mining out, let's say, on the moon, or space tourism, or orbital data centers. Ultimately, the modeling right now is by 2035, it's expected to be a $1.8 trillion industry. So again, one kind of just fun report for you to think about. The world in 2035, 10 transformative ideas. Now, just to finish out, we had a few other reports and sort of comments in our overarching Outlook publication this year. One is our approach to asset allocation, just sort of a reinforcing of the way we go about that. Second is when we come to how we actually invest when we're managing money for clients, how we're thinking about that. And then finally, where to find Stifel guidance. Of course, the answer is stifelinsights.com. And so, listen, thank you so much for watching this video. We're really excited to share with you our outlook for 2025. And again, as this video gets released a week hence, so it'll be the 15th of January, I'll be doing a live webinar with Brian Gardner. We'll look forward to seeing you then. Thanks so much.